Greetings, Culture Warriors. It is I, Jeff Vieira, author of Culture is Everything, and your host for this latest dispatch from the front. Another situation here in today's story where we have a company getting in a little bit of trouble over something that may conflict with their values. It's from the Business Insider. It's a story by Isabella Jibilian. Under Armour executives were warned they could be charged over accounting practices that may have violated securities laws. SEC investigators intend to recommend that the SEC move forward with allegations that Under Armour executives violated securities laws, according to documents released July 22nd. The SEC sent Under Armour a Wells notice warning Kevin A. Plank, Under Armour founder, and David E. Bergman, Under Armour CFO, that they could face SEC enforcement for allegedly manipulating company sales in a way that violates security laws. The SEC is scrutinizing Under Armour over allegations it used pull-forward sales tactics throughout 2015 and 16. When a company pulls forward, it shifts sales between financial quarters in order to meet sales goals. Though a Wells notice does not formally charge the company of breaking laws, it does indicate that SEC staff has recommended pursuing enforcement action. About 80% of companies served with a Wells notice face charges, according to a Wall Street Journal analysis of government data. The Wells notices inform the company and executives that the SEC staff has made a preliminary determination to recommend that the SEC file an enforcement action against the company and each of the executives that would allege certain violations of the federal securities laws, the company wrote in the July 22nd SEC filing. Shares of Under Armour were down nearly 4% in pre-market trading on Monday morning, but the stock rebounded by noon. Federal investigators have been looking into Under Armour's accounting practices since 2017. Last November, the Wall Street Journal reported that Under Armour was the subject of a federal accounting probe. The athletic wear company addressed the investigation in November, stating that it had been cooperating with the SEC since 2017 while denying wrongdoing. In the coming days, Under Armour has the opportunity to file a formal response to the Wells notice and talk with SEC staff in an attempt to resolve the issue. The company and the executives maintain that their actions were appropriate and intend to pursue the Wells notice process, the company wrote in a filing. Okay, so this can sound a bit like just kind of business as usual, arcane Byzantine accounting rules. And for that reason may not be worthy of scrutiny. But let's unpack a little bit of what's actually going on here. So why is the SEC concerned with pull forward sales tactics? What does it mean when they shift sales between financial quarters in order to meet their goals? Well, you have to consider that when a public company files their earnings reports, what they're doing is essentially saying, hey, this is how much we were projected to hit, this is what we actually hit, and then the market responds by pricing that into the stock price. So if you miss earnings, for example, they'll downgrade stock price. Companies typically have an annual seasonality to them. And it depends on when their fiscal year actually begins and ends. Many companies follow a calendar year, so that their fourth quarter ends in December, at the end of December, and their first quarter begins at the beginning of January. Other companies stagger this. It's not uncommon to have a 6-month offset to your financial reporting such that you have your year-end closeout at the end of at the end of June, and then you begin your year at the beginning of July. Many companies do that. It's also common in some industries, say if you're tied to tax preparation, for example, you might actually have the first quarter of your calendar year be your fourth quarter for the purposes of your tax preparation business, because that's when a lot of your revenue comes in as people are preparing to pay taxes on April 15th. So the importance of those quarters and that fiscal year end is that that's really when people take kind of stock on how you did for the year. Everything else is a prediction up until you get that fourth quarter in. Now you know how the year turns out. Bonuses are typically paid on that basis. So when they say that they were pulling forward, what it probably means is that they felt more sales than they needed to hit the goal in the fourth quarter of 2015, and then pulled sales forward into the first quarter when they were light. It could also be a situation where it was third quarter to fourth quarter being viewed as most important, so it may be they were doing that. But the bottom line of it is generally these kind of situations are kind of looked askance at because it's gaming your numbers to impact bonuses. And who really takes the hit when that happens? Well, typically it's the shareholder. So let's say the company hits a certain sales goal, and then their executives get a bonus for that. That money comes out of the profits of the company. What would have happened to that money if the sales numbers had just been played as they laid? Well, then they wouldn't get those bonuses. Where would that money go? Well, it would partially offset any impact to the stock price, but generally speaking, that would be reserved. And so arguably by doing these pull forward things in addition to kind of manipulating the market in a way that you shouldn't do, you conceivably are also hurting shareholders, and enriching yourself at the expense of the shareholder. So it's not a very ethical practice. What happens is there are some questions as to when you should book a sale. At what time does a sales count? And unfortunately, when people are under the pressure of their metrics and trying to get their bonus and everything, they can play a little fast and loose with the interpretation of those rules. They can sometimes request that people, we'll hold back on that. Don't pay that right away. And if your fiscal year is offset from your customers, that can be a real temptation, because it may not matter to your customer whether they pay a bill in 1 month versus the next, if it's not the end of their fiscal year when they have to do their year-end closeout. So basically, these pull forwards are a way to manipulate your year-end closeout in a way that throws off the market. Our stock market in particular, is based on information, high-quality information, and it's got to be recorded accurately and faithfully by the company. So trying to get out of bad news for the sake of your own bonus check is really something the SEC frowns on. And when they get to the point of issuing one of these Wells notices, as noted in the article, it's essentially an indictment. And the SEC saying, look, we are going to pursue this matter. Now, the company can say, well, we can explain. But it's got a real bad look to it. And so it has to make you wonder, if you own Under Armour stock, if their financial reporting is accurate. And so this really kind of puts not just the sales and marketing team under scrutiny, they're the ones probably most directly impacted by that number, but it also makes you wonder if you've got the right CFO. So those folks have to be sweating it a bit. But overall, it's hard to square if you have a company that puts a premium on integrity, and just about every public company you would think would. It's hard to kind of square that with financial gamesmanship in something as important as your quarterly findings. And generally speaking, it's the job of the CFO to keep people out of jail by making sure that those things don't happen. There can be, especially these days, quite a labyrinthine regulatory compliance regime around these publicly traded companies. And so one of the important jobs of any of these companies of any real size is to make sure that you're fully compliant with the regulatory regime you're under. And that generally means following the GAAP rules for accounting, generally accepted accounting principles. That's your first line of defense to make sure that you're doing the right thing and it looks the right way so that you're not exposed to these kind of complaints. It's always tempting to move something here, move something there to make your numbers come out right. And some aspect of the management of the company, you're expected to do within the legal rules those things that you can in order to ensure that you've got good numbers. So one example would be is if you notice that your revenue is down, then usually you need to take swift action to bring your cost down with it to try and preserve your profits to the extent you can. And also because you want to go into an earnings call and be able to say, yes, we know our revenue's down, but we've already taken actions X, Y, and Z to reduce costs in line with that and offer a new prediction for where you're going to be at in the next cycle. Now, I've worked for some companies where they got into a habit of not hitting their earnings numbers. So they would give that forward look to the analysts. Here's where we're at this quarter. Here's where we think we're going to be at next quarter. Here's where we think we'll be at for the end of the year. And quarter after quarter after quarter, they overestimated the performance of the company. It had a real deleterious effect on the company's stock price because the analysts take away. Their job is to evaluate stocks and help people decide where to put their money. If the earnings keeps missing, then they look like fools, and they don't like to look like fools. Their clients wind up making less money as a result. They don't like that. So if there's any whiff of nonsense in the numbers, it can have an outsized impact on the stock price. Now, in this case, the initial reaction, it dipped a bit. It came back up. Obviously, the market kind of views it as the fundamentals for that company are strong. They don't seem at this point to be overly concerned about the quality of the information we're getting. But as this proceeds, depending on what Under Armour's executives' explanation is going to determine whether there's some, follow-on impact to their stock price. The key takeaway from this story is, there's a lot of smart people looking at your numbers, and you're not going to be able to get away with it for long to cook the books. There's just too many metrics out there. If people start to get a sense that the truth is not being told, there are too many analysts who can inform the public with real data in that regard these days. So you're going to get caught. It's a matter of time. It's really not worth it to try and cook the books and then get hit by the SEC, because what's going to happen? All right, if you're on the board of directors for one of these companies and you find out that the CEO, CFO, and perhaps whoever the chief sales or commercial officer is, if you find out that they basically cook the books in that earning reporting, well, the first thing you're going to do is call for the heads of all of them. The CEO will probably get whacked even if they had no knowledge of this. If it was a conspiracy on the part of the CFO and the person in charge of sales, because they should have known. The CEO's fundamental job is to steer the company as a publicly traded company. And so if something like this has happened on their watch, that's typically curtains for that CEO. Now, depending on how the SEC rules, you could face penalties all the way up through jail time for the officers of the company. This is what happened with Enron and their famous scheme to kind of create these off-balance sheet partnerships where they tried to hide all their bad economic news for the company. And they got found out, and the CEO and the CFO went to prison for it. Short of going to prison, the SEC can also do things like remove your ability to be an officer of a publicly traded company. That's kind of the death sentence if you're in the C-suite. It is unlikely that you'll get severance bonus on the way out the door, because usually this is considered to be fired for cause, and boards generally don't like to be seen as rewarding this type of behavior. That creates a bad taste in the mouth of the SEC regulators. Here's someone who did something terrible in their eyes, and you're cutting them a big check on the way out the door. That doesn't go down well. So trying to pad your bonus while risking your freedom and certainly your ability to continue on in your chosen profession, giving up all the remuneration you otherwise would have been entitled to, and these guys are paid quite well. Well, it's just a case where the downside is just so much greater than the upside. It's simply not worth it. And you have to really question the values of the people in your C-suite if they'd even be willing to take that chance. Not just from the standpoint of, hey, you got some guys that are clearly have some integrity issues, but also just in terms of their rationality, you'd have to question it. It's a very, very stupid thing to do. So we'll see what the explanation comes down to. Perhaps this is in a gray area where there's emerging regulatory guidance and, it's a simple disconnect on something. But it doesn't look good. And so you want to keep an eye on Under Armour. Whenever you see these incidents come up, it's always a chance for the company impacted to take a good hard look in the mirror and see if they are living out their values. If it turns out that this is not a very laudable thing to have done, then that board is going to have to take swift action, make very clear that that is not tolerated, sack everybody that was anywhere near it, and kind of bring back into the culture the notion of integrity. You see this, by the way, in companies that are responsible for auditing some of these heavy hitters. There have been some major accounting firms. The Enron case was one big example where they've had accounting firms that had been around for a long time, very well-respected accounting firms, put their reputation on the line for these companies, and then got exposed as not doing their due diligence in their audits, and their reputation was absolutely destroyed. Who wants to hire Enron's accountant? Nobody. That's just asking for trouble. So this has ripple effects that go well beyond the company in question. Not a good thing to do. Integrity first, integrity always. It's important to make sure that honesty is the primary value within our cultures. Because at the end of the day, making your bonus, making your wife happy, making your husband happy is one thing. But culture is everything.